G'day expats and welcome to another episode of Expat Chat. Today, episode 89. And today Brett has gone on leave. He's left us. He's on holidays at the moment. So I'm joined again with my colleague who's in the Gold Coast office, one of our financial planners, a specialist for the APAC division, Mitchell Kelsey. G'day, Mitchell. How are you going?
Hey James, doing great, thank you. Thanks for having me back on. How are you,
No
mate?
worries, mate. Yeah, I'm good, mate. I'm good. It's a pleasure to get you back on. I think we'll get you doing a few more episodes as we wind out the end of the year. I think we're all getting a bit over Brett Evans now. He's on a holiday and he's trying to grow a beard. I think he's trying to match my beard, and I can see there on your side you're growing your beard. So I think beards are in at the moment. Um, Mate, today we've entered a new financial year. Well into July now. It's been an interesting July to start. Had the RBA decision, which I think was a bit of a
Mm,
surprise, having that pause. And that now that we're in a new financial year, some of those changes they announced to Super, just some legislative changes, have now come into effect. So I thought, what a good opportunity to talk about it with you. So we'll deep dive into it. I'll just do a quick disclaimer. As Brett's usually pretty good at these ones, but I'll just spin this one as well. So anything you hear today, to our listeners, ladies and gentlemen, seeing us on YouTube as well, is general information only and should not be construed as personal advice. You know, if you're listening to us, it's for entertainment purposes only as well. If you do need advice, please reach out and seek advice from a qualified, accredited financial planner or advisor or accountant, much like what we do. Let's deep dive into it today, mate. So talking about some of the changes, there's been a few that have come through.
Yeah, that has. So I think in today's episode, just looking to cover off on for the big ones. So I guess transfer balance cap. So that has increased from the beginning of this financial year. We're going to talk about some of the changes to non-concessional contributions and concessional contributions. And then lastly, we'll talk about a contribution type that's not really talked about too much, especially in the context for Australian expats, and that's the downsizer contribution.
Yeah.
So
Yeah,
I
that's right.
mean, to start off with, I think the big one is this indexation of the transfer balance cap.
Mm.
So not sure if you wanted to give a quick high level summary in terms of
Yep.
what the transfer balance cap is and what it's increasing
Yep.
by.
Yeah, so I mean, and zooming out a little bit more, it has index, which is good news. What's frustrating about them only applying indexation to this transfer balance cap is they didn't do it on the contribution caps. So they didn't touch the non-concessional contribution caps or the concessional contribution caps, which is a little, again, frustrating. It means maybe when they assess it in January next year, ideally we get some indexation then happening. But bit frustrating that they do the transfer balance cap, but not the other side. So the
Agreed.
transfer balance cap, it's essentially the maximum amount that we're going to have in that pension mode. It's also used to qualify certain other things, but generally speaking, transfer balance cap deems what we can have in pension mode, which is going to be completely tax-free. It'll be tax-free from an earnings aspect. So if you've got some shares in your pension and there and you sell some of those shares, you make a capital gain, well, you don't have to pay any capital gains tax within your superannuation account, which is great. So that's another benefit of that pension mode. Probably one of the other benefits is when you receive your dividends from your investments, that's tax-free also, which means you get the lovely franking credit refund going back into your pension account. And then lastly, the income, the actual pension itself that you're drawing down on a monthly basis, you know, whether it's 3 grand a month, 4, 5, 10, that's all tax-free in the eyes of the ATO. You don't actually have to report that in your Australian tax return at all. So that's what we love about our superannuation system. With the recent indexation applying to this transfer balance cap, it means it used to be 1.7 million you could have in pension mode. It's now rolled over and it's 1.9 million that we can have in pension mode. So that's what it's been indexed by, essentially 200K. But there's some really unique formulas which operate in the background if you're already in pension mode. And just because you're in pension mode before 30th of June doesn't mean you suddenly get that 200K increase. You don't, unfortunately. And I think that's going to catch out a lot of people. And they might think, oh, great, I can throw in another 200K and do what we refer to as a recontribution strategy. But not the case. Not the case at all. So that's probably a really good high level summary on the transfer balance cap. But with that in
Yep.
mind, I'll kick it over to you, Mitch, because it does mean there's some other opportunities we have with contributions.
Yeah, exactly. And yeah, great summary, James. So they've increase the the amount we can have in pension mode from 1.7 to 1.9, but they're also looking at capping it at 3 mil in the next couple of years as well. So a benefit for now, but yeah, just need to keep in mind that 3 mil cap, which hasn't come into effect yet, but may in the next couple of financial years. And exactly what you said before. So this transfer balance cap, it sort of translates into eligibility requirements for making a contribution type that's referred to as a non-concessional contribution. So a non-concessional contribution is money that you contribute after tax. So you can't claim a tax deduction on it, but the super fund also doesn't tax it at 15%. So previously, like last financial year, for example, the non-concessional contribution cap is 110,000, but in order to make a non-concessional contribution, your total super balance needed to be less than the transfer balance cap, which was 1.7 mil last financial year. So now with it increasing to 1.9 mil, that gives, I guess, members who had a super balance anywhere between 1.7, up to 1.9, the ability to now contribute to super. So that's sort of the additional opportunity there. Being able to contribute anywhere between 110,000 up to 220,000 if your balance was anywhere between 1.7 to 1.9. And when I say 220,000, the way you're able to do that is by triggering the bring forward rule. So effectively, you're able to bring forward a future financial year's worth of non-concessional contribution cap space.
Yep.
So that's probably the key difference or the key change that's happened to the ability to make additional non-concessional contributions from this financial year going forward. Did you have anything you wanted to add to that?
Well, non-concessional contributions, with them being after tax, they're probably the most common ones that I see with a lot of clients overseas putting into their super. Because if we're a bit older and maybe we're thinking about retirement in maybe the next 5 to 10 years, that's probably the quickest way that you can dramatically increase that balance. I know, Mitchell, I know you and I, when we're working with our clients, that some of the hard things we look to do is trying to shoehorn as much of our clients' wealth, which is outside of super, into super. That way, when they repatriate, they retire, they either move back into the old home or they're buying a new home, they're able to essentially turn on that income tap and, you haven't sort of wasted your time. The hard part, which is on the opposite side of that strategy, is if you're coming back to Australia and you've got a lot of your assets invested in shares and other pieces and bits, and then you want to start putting into super. Well, in order to do that, you're going to be selling things. You're going to be causing capital gains tax events. You're going to be paying additional tax compared to maybe when you were an expat and a non-resident. And a lot of it might have been out of the scope and out of the reach of the ATO, because maybe a lot of it was coming from that asset class, non-taxable Australian property. What I thought was interesting with the way that they've indexed these caps, they've increased it obviously by 200K, which we discussed, but depending on your balance, you can technically get 220K in. So even though the indexation's been 200K, when you make these non-concessional contributions, it might take your balance just over 1.9, which is a bit strange. But I think that's also probably factoring the case that we're probably still going to get indexation going forward each year. So they'll keep moving the goalposts there. I'm hoping for expats, my clients in particularly, that they look to index those contribution caps and they lift them. They take the concessional from 27,500 to say 35. They take the non-concessional from 110, maybe whack it up to 125. We'll have to wait and see, but that's probably a good segue into concessional contributions and what's going on with that catch-up one.
Yeah, so with the concessional contribution, so the changes with the concessional contributions from this financial year, it's got nothing to do with the changes to the transfer balance cap that we talked about previously. But I guess just in summary, a concessional contribution is a before tax contribution. So you make the contribution and you can claim that as a tax deduction in your Australian tax return. But because of that, the super fund will take a 15%, will tax that at the concessional tax rate of 15%. And essentially that's affording you a tax deduction. So, if your taxable income is, say, over 180,000, if you're a non-resident, you're paying tax at 45% on that income, or even, Australian resident for tax purposes. So if your income's over 180, you're paying the same, 45% plus 2% Medicare levy. If you contribute, make a concessional contribution, that amount you can claim as a tax deduction. It's taxed by the super fund at 15%. So, on that amount that you contributed, tax of 15% versus 47% in your income tax return. So that's sort of a concessional contribution, and that's the benefit of it. Now, in the 2019 Australian financial year, they introduced this catch-up concessional contribution rules, which effectively, allowed you to utilize concessional contribution space from previous financial years and use it in the current financial year. So basically allows you to use the last 5 years worth of concessional contribution cap space, and you can actually use it in the current one. So this current Australian financial year, it's now been 5 financial years since they introduced that. So this is the first financial year that I guess we have the full last 5 years worth of concessional contribution space or unused. Like, for example, if we hadn't contributed over the last 5 years, we can contribute that unused cap space in the current Australian financial year. And I would say this is something of significant benefit to Australian expats in particular, because it's likely, Australian expats, they're not receiving super guarantee contributions, whilst they're overseas, they're employed by a foreign employer. And as we know, super guarantee contributions are a type of concessional. So they will contribute to your concessional contribution cap space. So likely, most Australian expats, they're not going to have any concessional contributions being received over the last 5 years. So provides a huge amount of cap space available this financial year, particularly if you can, for example, if you're selling a property, for example, you've got a large capital gain. You can, look to offset that capital gain by making that catch-up concessional contribution.
That's right. The catch-up concessional contribution, it's probably one of the best pieces of legislation that has ever come through, and they haven't touched yet, because being able to pool, say, up to, I think it's about 157,500 now in.
I was just going to do, I was thinking, doing the calcs in the back of my head. So
exactly.
157,000 that you can contribute.
And being able to pull that together and to give our listeners and for those watching on YouTube, thank you, a bit of insight. So let's say you and your partner, you own an investment property back in Australia, and let's say the capital gain on that property is just over 300,000. And this is factoring in all the different concessions that you might have received for when you held it as a tax resident, as well as, what's going on while you're a non-resident. So, I'm not going to do any of those calculations, but let's just say you've sold the property and the capital gain on that property is $305,000. Okay. And then because you jointly own that property, naturally that means, you're both going to have 152,500 that you're going to have to put in your tax returns and then pay non-resident or foreign resident tax rates. Now, remember, tax rates for foreign residents, 32.5%, and then it tiers up to 37, and then it's 45%. So it's 32.5 on the first 120, just to give everyone a bit of insight. And then it tiers up again to 37 and then 45. So pretty aggressive, but a significant amount you're paying in tax. Now, if you had someone guiding you and advising you, assuming you haven't made any other contributions to super, which fall in the concessional category for the last 5 years, you would be able to put that entire capital gain, just the gain, not the entire proceeds, but just the gain, into your super funds each, claim that as a tax deduction to offset the capital gain, and you will only be paying 15% tax on that capital gain rather than 32.5%. And, if I was to do the calculations, that's just saved you thousands and thousands upon tax to the ATO. That's the kind of strategy opportunity that we have in the current financial year. And what they're saying, and as part of the legislation changing, is use it or lose it. If we have unused amount going back from 2019 financial year, and then we've used some other years of the pooling, then when we roll over to the next financial year, that's 25,000 technically that you'll never get access to again to put into your super to offset some income or a capital gain. So pretty pretty big loss, to be honest, from an out-of-pocket tax bill side when we crunch the numbers. The other thing that Mitch said before was the super guarantee rate, 11%. It's gone up now, 11% in the current financial year. So it went up by 0.5%. Just bear in mind that depending on where you are in the world, you might not have an employer putting 11% into your retirement fund, depending on where you are. So if you're not saving at least 11% of your salary and contribute it to the retirement aspect or have some sort of strategy in place, then you are already at a loss of your counterpart or mates or colleagues back in Australia. So make sure you plan ahead around that, because there are ways that you can be contributing to your super to keep it growing. There's also caveats around that depending on, what countries you are, i.e. the United States, you've got to be careful and cautious there, the way the IRS treats those sort of things. But that's the way you should be thinking, especially if you are going to return back to Australia. Technically speaking, and Mitch would agree with this, if you're putting in just say 11% of your salary as an after-tax or a non-concessional contribution, which the cap is 110,000 a year, you should actually outperform and beat your mate that's back in Australia that's receiving his super guarantee rate. And the reason why is because he's having to pay tax in super on that contribution at 15%. So he's always going to have a 15% discount applied to his contribution, which means he's only investing 85% of it versus you investing or getting to invest 100% of it through super. That's another important takeaway. And I'm going on a bit of a tangent. So Mitchell, you're going to have to reel me in. The next one, the downsizer. Mitch, I'm going to kick it over to you just to let everyone know what is the downsizer.
Yeah, sure. And I might just caveat that catch-up concessional contribution rule as well. Like your super balance needs to be less than 500,000 on 30 June of the previous financial year. So that might be a bit of a catalyst to look at using that concessional contribution, that catch-up concessional contribution rules as well. If your super balance is approaching 500,000, and you've got all this unused concessional contribution cap space, then if you don't use it, your super balance ticks over 500,000. It's not going to be available like going forward. So just sort of caveat that as well. And James, the downsizer contribution. So essentially, what the downsizer contribution is if a individual has owned their home for greater than 10 years, they then dispose of that property, they can contribute some of the sale proceeds, up to 300,000 per person into super.
Yep.
And this contribution is not treated as a concessional. It's not treated as a non-concessional. It's also not subject to the eligibility rules that non-concessional contributions are subject to. For example, the transfer balance cap. So your super balance could be 2 million. You could still make that downsizer contribution because it's not the same rules don't apply to the non-concessional contributions. And the reason we're talking about this downsizer contribution is because the age eligibility has changed. So previously it was age 65. Last financial year they changed it. They reduced it to age 60, and then from this financial year they've reduced it again to age 55. So effectively, if we look at some of I'll go through the list in terms of the eligibility again. So just to summarize, you need to be at least age 55. You need to have owned that home for the last 10 years. And usually you need to make the contribution within 90 days of the contract of sale.
That's right.
But one of the most putting this in the context of an Australian expat. So what's critical is you need to have received at least a partial or full exemption on some of the capital gains from that property by utilizing the main residence exemption. So this is not something that most, if it's only ever been an investment property, this is not something that you can utilize. And I guess, again, putting it in the context of an Australian expat. So a lot of Australian expats, they have a previous main residence that they lived in before they moved overseas. May have lived in it for 2 years and then moved overseas, rented it out as an investment property for 8 years. That they come back in year 10 or year 11, So that is 10 years. Like you've owned that property for 10 years. So it doesn't, you don't need to have lived in it as your main residence for 10 years to be eligible to make that downsizer contribution.
And it's really interesting that, because when you think about a lot of expats, they might have a property that they've purchased whilst they're overseas as an investment, maybe with the intention of moving back in it. Life changes, life gets in the way. So you might just keep that as an investment property. You come back, you live in it for maybe a short period, a year or two. That way you're establishing it as a main residence. And as long as you've owned that property for 10 years, it has been your main residence, or it's entitled to some form of the partial main residence exemption. You could then sell that asset. You would then be eligible, assuming you're over 55. You'd be eligible to put 300,000 into your super, plus 330,000 into your super if you haven't maxed out any of your after-tax non-concessional contributions. Further to that, if that property's gone up in value and you've got a taxable capital gain, you could also then make use of the catch-up concessional contribution to offset that capital gain. So a savvy investor or a savvy expat that wants to boost his superannuation plus your partner's superannuation, or vice versa, you could technically get 1.575, and I just crunched the numbers, into your superannuation environment by selling that property and having the capital ready to go. That's huge. That is massive, because you're putting that 1.575 into super now that you're back in Australia, and the maximum tax rate that you'll pay on those earnings going forward is only 15% compared to your marginal tax rate, which, if you're working and you're employed and you're earning maybe 80,000 or 120,000 or 200,000, it's a lot more than 15%. So you've really structured that scenario to your benefit for the long term to really support your retirement. So that's a really good insight, Mitch.
Yeah, and I thought it was interesting, like it works in the reverse as well. Like it may have only ever been an investment property, and you come back and establish it as your main residence at that point. And you can be eligible so long as the ownership period is 10 years or more. And what a lot of, I guess, individuals don't know as well is it's for yourself and your spouse. And the spouse, for example, one of the spouses doesn't necessarily even need to have been on the title as well in order to be eligible. So this is 300,000 each. So a couple of nuances that I guess aren't so, I guess, known to most people around this downsizer contribution.
That's right. Remarkable, actually. Remarkable that you don't even need to be on the title to qualify for it. And it'd be really interesting to read up in the legislation of what is a qualifying spouse under the tax rules around this. Because I always wonder where anyone's getting a little bit creative with a friend and trying to get a little bit more into super. So it would be very interesting, that's for sure. Maybe history of tax returns and, recording each other on your spouse income and those sort of things. That's all I can think of, to be honest. In the meantime, mate, that's probably a really good spot to hit pause. Obviously, a bit of an update on new things for the new financial year. It's tax time here back in Australia as well. If you're self-lodging your tax return, you've got up until the end of October to get it squared away. If you're using an accountant, well, technically you've got up to March next year. So make that decision, start getting all your deductions together. If you've got HEX debt, unfortunately, you do have a HEX repayment lodgement to do. Remember, it is based off a percentage of your overseas income or worldwide income. So if you've got a HEX debt repayment coming, just be mindful of that and start preparing maybe that cash and that capital to do the repayment. I think probably a common one that comes about is if you get that HEX repayment and you owe 10 or 15 grand or something like that, remember you can put that on a payment plan. You can put that on the payment plan for the next 12 months or next 2 years until you do your next HEX lodgement. So I think a lot of people often get a bit scared around this time when that comes up. In the meantime, guys, it's been lovely having Mitchell on. We'll see you guys on the next episode. Thanks for tuning in.